Let's talk about Social Security and income taxes. So in previous modules, we've talked a little bit about claiming early, claiming late, delaying, things of that nature, the age at which you take Social Security. Well, Social Security and income taxation is going to apply regardless of the age that you activate your benefit. Whatever age you are, it's really immaterial as to whether or not there may be taxes due on your Social Security. What's interesting about the taxation of Social Security, at least in the state of California, where I live, is that Social Security taxes, or I should say income taxes on Social Security benefits, are only at done at the federal level and not the state of California. So as of the time of this video, there are no income taxes due for Social Security income that you receive on the California side or on the state side. Just occurs at the federal level. So really, Social Security, if it's only taxed from the federal and not the state of California level, it's a tax favored source of income. So as you can maximize Social Security, if you can get more dollars, each of those dollars is more valuable than a dollar that you get from another source because you don't have to pay taxes at the federal level, I should say at the California level. And even at the federal level, you're not going to pay taxes on 100% of the benefit. There are three tiers of potential taxation. And the first is a 0% of it is taxed. So it's a possibility that 0% of your benefit will be taxed at the federal level. The next possibility is that 50% of the benefit that you get will be taxed at the federal level. And the last option is that 85% of the benefit that you receive will be taxed at the federal level. So there's only three tiers, 0%, 50%, and 85% that are used in determining the total taxation of the benefit. It's very important to understand that these are not tax rates. So it's not a 0% tax rate or a 50% tax rate or an 85% tax rate. Sometimes there's a little bit of confusion there. It's just saying how much of the benefit that you're getting will end up on the tax return in order to be taxed. Well, which of the three is it going to be? It depends on what's called provisional income. And provisional income is a concept that the IRS dreamt up. And here's the formula for determining provisional income. We've got our adjusted gross income. And if you think about adjusted gross income, it covers pretty much everything. So it's going to be your work income, it's going to be your rental income, and it's going to be your income that comes from dividends. It's going to be your income that comes as a result of taking money out of your IRA and 401k accounts. Adjusted gross income is the very first page of all of the income. So pretty much covers everything. And we'll only add half of the Social Security benefits to the adjusted gross income. And you're also going to add the amount of any tax-exempt interest, like municipal bonds, to the total. You add those three pieces together, and it is the total of what's called the provisional income. And there is a chart that's used to determine what tier of taxation an individual would be at. So first column is what filing status you are, married versus single, or married filing separately. And then you've got the provisional income tiers. And then you've got the amount of the Social Security benefits that are actually going to be subject to tax. So if you're married and you make over $44,000 of provisional income, 85% of the benefits that you get from Social Security will end up in the column on your tax return being subject to tax. If, on the other hand, you make less than $32,000 of provisional income in a year, none of those Social Security benefits are subject to tax. When this chart was originally created, one of the unfortunate things is that this chart is the same this year, the previous year, and a decade before that. There is no indexing of inflation for the amount of the provisional income. So more and more and more and more and more dollars of Social Security benefits are being subject to tax each and every year because this chart is an unchanging chart.